live from the Blue Studios. Hey!
Welcome again to the weekly show of Next Week with Travis and Eric, and this is episode 3. And I'd like to introduce my co-host of all times in New York is Eric Maloney. And also we have a guest in New Jersey is David Petrie.
Hello.
Wonderful. And I just want to recount what we did in episode 1. We talked about this hybrid environment that we are taking node consensus, blockchain, and cloud. And everyone believes it's only immutable data and blockchain, but also we're doing a hybrid into secure tamper-resistant silicon and SIMs. So we have this great architecture, more secure, people argue. And then with Adrian on the second episode, we talked about, what are banks doing with blockchain, and banks, if they tokenize deposits, really nothing changes. The compliance is most the same, the applications, the transactions, we're just using, and I'll use the Jamie Dimon comment is why would we not use the most secure known database in the world going forward? So great. And now on episode 3 is that, we've seen this ever since crypto and blockchain came out, all this investment, Bitcoin and all these altcoins and so on, making people money. They fluctuate in the wind. There's no reason or rhyme why they have value and so on and so forth. And really, this episode is not to talk about the investment opportunities out there, because it's not here today, is how is blockchain and using immutable data and automated processes in these large asset managers and the banks and the investment banks and Wall Street with stock markets and so on, how is this better using this type technology? And maybe I'll start with David here. And David, is that, maybe list some things you think are advantages. And one thing I do know in tokenizing large, asset managers, they can transact with other asset managers and other portfolios very quick. And I know that, JP Morgan Onyx, although not in commercial use, have tested with Barclays and with BlackRock and so on, is that they can move and do these derivative trades and different things very quickly and use collateral in one pool and make the investment efforts in somewhere else and so on. But in auto rebalance risk in portfolio and where do you want money and so on and so forth. But David, please share with us from a technological perspective, what advantages you see in the investment arena?
Well, first of all, thanks, Travis, for having me, and Eric. Pleasure to be here. And it's such a great question. And there's this holy grail that's out there, right? That is being chased by various different stakeholders, big stakeholders, right, in markets. So whether it's the largest asset managers in the world, like Apollo, or the G-SIBs like JP Morgan or Citi, Barclays. These banks are trying to find ways to unlock their balance sheet and to create what they would call a higher velocity of being able to accelerate their decisions in lending, for one, so making those loans. Number 2, being able to bundle their lending into securities or to securitize them. You've probably heard that term before.
Sure.
And then number 3, to be able to scale sort of that first order of lending or securitization, and then to have those activities live in a secondary market or marketplace.
Secondary markets is key. Yes.
Yeah. And so I've been personally blessed to be a part of some pretty interesting endeavors in that space. Everything from trade finance to whole loans to small, medium-sized business loans, and even B2C, how to accelerate sort of lending decisions into direct to consumer, both in the US and abroad. So it is a really exciting space. Banks are investing a lot of time and energy into technology. They've been hurt, of course, over the last few years in terms of what's happened to venture and the capital ladder, sort of a bit more difficult. But one more thing, and I know I'm good at talking, so I'll shut up in a minute. But
no.
But one thing that's very interesting right now that's happening is that banks, biggest banks with biggest budgets in terms of innovation, and really the biggest fear factor as well, when you think from a bank's perspective, about some of the things that you and I and Eric talk about, where we're going to be going. At times this can be quite threatening to sort of the banking system as a whole, right? But if you think about what banks are doing to try to close that gap, they're now taking their venture and innovation departments, that were chasing the bright and shiny things and investing, but the actual application of these new technologies and capabilities really weren't being adopted by the banks themselves.
Right.
And that gap was seen as pretty embarrassing, especially when the bottom fell out a few years ago in crypto in the space. So they're starting to embed these investment decisions into the businesses themselves, where there's then an accountability in terms of, if you're going to invest our money here into this particular technology, you need to be able to adopt it into real life use cases. So I'll pause there, but yeah, it's an exciting space, and I'm really quite interested in seeing how we can move the needle in terms of making some of these things really come to life.
Well, that's a great overview, and maybe I'll turn this to Eric right here. Is that use cases, right? And you're right. Is that banks aren't known for innovation, and banks are. I mean, still today, everyone thinks that because you have a website, you have mobile apps, you have all these things that it's automated. It's all human process for the most part. And so that's critical in there. And so on a use case side, I'll turn it to Eric right now. And Eric, from a use case perspective, how do you see what David says, and what comes top of mind, on use cases for, investment instruments or process and so on? And obviously we've had a lot of conversation, AI. It's kind of a mixture of things right now on the topic. So Eric, please.
Well, I like what summary David gave about how the banks got where they are, right? I used to work in the financial sector, and the large banks, it was a joke. When you talk about the technology, you ask what they have, and the answer was yes. They try everything. They adopt everything early, not wanting to miss out. But there's a very long tail of technology in banks. They have to go through a lot of vetting of technologies. They have to go through a lot of risk analysis. Adoption is slow. So I wouldn't say that they're not innovative, but they're innovative on their timeline, on their business cycles.
Right. Yes.
So I also like what David said. They've been looking at things like blockchain for several years. And it was kind of a slow start, where people thought it'd be a quick adoption because of the security of the actual program, the de-risking through a distributed ledger, through the single point of failure not being in the design.
Right.
All these good things, but it is something that raised other points. Well, if it's not fully distributed, how can it be fully trusted? I mean, if it is fully distributed, how is it fully trusted? How do you register trusted nodes? And then how do you know that everyone's doing the same thing in the same way at the same time?
That's right.
It took a while. And to that point, the banks, the large GSIBs, as David said, have been building internal services with blockchain for several years. So they actually do know that they work very well for non-public facing, non-customer facing solutions. They've been all, I think, without fail, we mentioned just because of the GSIBs, Barclays and JP Morgan have built things for reconciliation. Right. And for years, the biggest thing was, how do you reconcile by end of day? How do you clear out everything for derivatives? How do you clear out end of day processing? You can take processes which were pushing up against the 24-hour mark and collapse them into basically how fast can you create a report? Right. Because the data is already residing in the blockchain, right? Now you already have all your smart contracts executed, they're in the blockchain. All the information is almost immediately available at any given time. So now you ask me about the use cases. They build themselves. Banks do so many shared services that one will take a point on. One will be for foreign exchange reconciliation that the rest of the street shares. One will be on the derivatives reconciliation, and so on and so forth. I see this being less that somebody takes the lead on it, but they're now going to be in these consortiums. Yeah. What could be very interesting about these consortiums is they may not be just the GSIBs anymore. They may be extending to other institutions, or at least democratizing access to some of these services for other institutions. Because extending the nodes is really going to be following a certain criteria, which is public. The other thing that I always like to say when we talk, I think it's mentioned on the previous episodes, and I'll say it on all the episodes, transparency.
Yes.
Banking is kind of an interesting organization. They have to have transparency in what they do for regulators, for their customers, for trust. But they're very secretive on their secret sauce of how they do things.
Yes.
Well, how do you balance that?
Right.
And you're going to balance that in how they go about building their processes in the smart contracts, how they have these consortiums built, the inclusiveness of them, the exclusiveness of them, because the days of really having the man behind the curtain are going to be closed by these new technologies. Everyone's going to have to be continuously innovating.
Yes.
And I think that's really something that the regional banks never had access to these services without paying a premium. Now I see some of them probably stepping up and saying, hey, we have expertise in providing equity into smaller markets. Why don't we create these smaller associations? They don't all have to be interlinked, but they can be. And that's what's going to be very interesting. I see use cases where liquidity pools are going to find new consumers, and those seeking credit will be in new marketplaces. And the permutations, as David said, he's had a broad experience from B2C or the different B2Bs. There's nothing you can't do with blockchain and smart contracts. There really isn't. As long as you have the understanding of the process, the regulatory requirements, the financial wherewithal to put them together.
Sure.
Right. And one last critical thing that the banks are really good at, the exception processes.
Well, absolutely. And, you mentioned a lot in there, and I appreciate that. The one thing that just top of mind and stuck, with me is that, the inclusive nature of financial services, everything from Reg D moving to Reg A and A plus and everything else. And also just getting access to lending and financing to businesses that should have it, but they don't get on the radar of most banks, and they don't care about it because it's too difficult to so on and so forth. And this is really an investment question. It's just something I thought of now is if you have blockchain, and one of the things that Tyrone, CTO of Onyx, said is that, we can in 3,000 transactions in one. So like you said, that 24-hour clock, all these transactions can be all reconciled and done very, very quickly and in an automated fashion because you have mutable data and trusted sources. So if you're a private lender, I'll just use what David said on the lending side is one of the investment. It's actually a very nice, new, very regarded asset class. Everyone's pouring money into lending right now. Is it in the interest of the lender? Let's say if I'm a hedge fund and I'm the head guy and I have 100 billion to deploy, is it better to have very minimal customers, a lot of money with them, or a lot of customers in smaller amounts? And the reason I say that is you can balance your risk, you can change things, you can liquidate, you can write off in a much more granular way and take advantage potentially. I don't know if that's actually from investment is what the hedge fund might be thinking, is going after a lot more customers than just a few, but I can see how they might be locked into certain investments that they could move around if they had more in the portfolio, if you will. And that could be any one of you, but that's kind of what came to mind.
Yeah.
I'll defer to David first.
Yeah, thanks, Eric. So just if I could, I just want to actually react to one or two things Eric said, and then come back to your comment, Travis, if that's all right.
Absolutely.
So, Eric, the consortium-driven progress is so very real and tangible, and it's happening at very special scale right now across these biggest banks, and actually in the smaller bank sector. And frankly, we should probably have another podcast for just speaking about the smaller sector and what's happening there. Smaller banks, meaning they're like 250 billion. But for the bigger banks, I know specifically a very ambitious, very much a bought into consortium, C-suite driven across biggest banks that are doing exactly what Eric is talking about. where they're going after these reconciliations in the back office on the legacy systems. Here's the elegance of vision, right? So one of the companies, I don't think I can say or should say what it is, but the company that has organized the consortium and spent about the last 3 or 4 years and working on these movements of payments that are going back and forth across these banks every day, is actually the mapping. And so these consortiums are then unlocking the transparency into mapping from these source systems, settlement systems,
Right.
across these reconciliations. And then the elegance here is, the vision is that once the mapping is complete, they then put on top of that mapping the blockchain, and being able to direct movements on the chain after that mapping. And of course, on the blockchain is then when you're finally are ready for your payment stable coin. Hopefully it's agnostic to which bank, it can't be JP Morgan's or Citi's, and we can have a whole conversation as to why that would be. But anyway, that was one reaction to Eric. Consortium-driven progress is very real. It'll be a great way for us, obviously, to move some of the things we want to get forward as well. And then coming back to your question about these big and small funds, whether they're asset managers or hedge funds that have capital to put to work, and is it better to have a narrower funnel or a wider funnel? One of the most interesting fun things to follow is the quantitative analysis of how you make those decisions. And increasingly, I know it's used too much, but AI-driven sort of power in terms of how you can take data and segment it, into smaller and smaller and smaller slices to understand the behavior of that data in actually near real time for unstructured and structured data, where you can actually have this diversification, like a wider funnel, going out with a deeper and deeper real-time learning in the behavior of those borrowers. And that's what gets me, excited about how you move the needle in terms of accelerating capital into the real economy, creating jobs in a more resilient banking sort of marketplace. And I picture the marketplace being one of the top words for the next couple of years. And I've gone all in on that word in terms of trying to keep my North Star of where I'm going.
Well, that's absolutely beautiful. Eric, you have any comments on that? That's a lot to comprehend, but maybe I'll take a whack at it first.
No, I think, David brings insight, and of course, we can talk conceptually about a lot of things. The details are still internal to a lot of companies right now. These consortiums are not really public facing. They are at the C level, right? But they're proving out the technology. But to get back to what's interesting about your question of the private equities, and they have assets to invest, and how can they do this, or are they going to do this at scale? Are they going to go after much smaller types of investments? Thanks to not only the blockchain, but thanks also, as David said, to AI, they can. Because now if you're an equity company, you historically would focus on the company, have deep analysis on it, understand what its component values are, decide if it's worth reinvigorating the company, dissecting the company, whatever you do. But it's really a focused event on a finite number of people, focusing on using large amounts of money to turn an investment. It's going to be interesting when they start seeing the marketplaces that David just mentioned. And now you're private equity and say, let's put our analysis into understanding the smart contracts. Let's put our analysis into applying AI to all the metadata that's in the blockchain, that's reflected in the transactions executed by the smart contracts. Now they'll have an insight into what trends are, what the risk profile actually is, rather than having this actuarial hope of understanding what's happening. You're actually going to have, as I said, near real-time data of what's happening. And you're going to be able to say, okay, now let's throw a 0.25% interest change into this model, and let's do a couple of small things. And the AI is going to say, yes, with a pretty high confidence level, you're going to be able to come back and see where you want to place some money, or how much money you're going to get back on what you place. So it's going to be transform how all investors work. But I think private equity more than others, they're going to open the floodgates for them in whole new markets that they otherwise haven't played in very often.
Yeah, it really is an exciting time, and the one of the things that I focused on for many years now is building local economies and building that up, and truly at the end of the day is the wealth distribution, all those things, and I do believe that is that accessing the smaller guy, if you will, and that's deserving of that, and giving the tools to decision makers, and it comes down to it's interesting. I'm a very big believer in standards. And there's ISO 222, which is the financial information and payment data flow, and SWIFT, KPMG, and they've been really pushing this because it just is more informative information. It's not a payment, it's not a settlement, it's a standard way to communicate between banks. Think about when you say AI, looking at all that data and presenting it in a way that's not manual for then someone to then very quickly act and decide upon that. And very interesting. And they're merging global commerce trade documents, invoices, letter of credits, requests for finance. I am a hotel and I need more, whatever it might be, is that you're getting all this rich information. And when I first looked at the standard and heavily got involved in it, I said, without AI, you're lost. Right, in a way,
Just
in a way.
to follow up on that, people forget that the real trick to generative AI is context.
Well, true.
What you said is now within the ISO regulations, within the types of contracts that are being developed, within the bylaws of an organization that's participating in a market. That's context. So AI can be, rather than speculative, it can be, I hate to use the word predictive, but it'll be proactive.
Yeah.
And say, here are trends that are understood, and here's what you can do with it, and make recommendations. And this, we're just at the beginning of the beginning, but already it's very promising what AI can do. Just remember that word, context. I think, David, I like marketplace, I agree. And,
right.
And the context of AI is the other thing I'll always say in a conversation about AI. The more that you can provide context to an AI model, and the user's persona that's leveraging it, the more successful the outcome is going to be.
Yeah, very good advice.
And we have a couple minutes here to wind up, and trying to keep this to 15 minutes and keep to the word of that. Like we could talk for hours here. What's really interesting is the the investment bank dealer broker market, and how that there's a heavy on compliance. There's knowing that people that you're raising money from and distributing and so on. But I see the blockchain just literally sets investment banks apart utilizing it for all the things that they need to do. And David or Eric, but maybe David, with your background, any comments to that and how blockchain is being utilized in the capital formation and origination type, markets?
I'll make a couple of comments, and then Eric may have more sophisticated ones than me. But so what I do know is that surprisingly, it still remains quite a manual process for onboarding new clients, whether it's into a broker dealer or into an investment bank. And there are some pretty increasingly sort of efficient ways that you're capturing documents and things like that, but it still remains a pretty manual process. The next generation of onboarding, which obviously we're really excited about, Travis and Eric, in terms of what, our next thing that we're doing. But that rapid, I call it rapid onboarding with higher confidence levels in terms of, that person or persona that you've brought on board, that will unlock then really, in my opinion, that will unlock us in terms of being able to step into a strategic architecture for then how you're moving value across this very high confidence driven onboarding of confidence into these broker dealers / marketplaces. And a lot of that's going to be partner driven. There's been a lot of work, and Eric can probably comment a lot more than I can, but there's been a lot of work in trying to reduce friction there, but there's still a lot more to do. And I think, there'll likely be a game changer in terms of of how that gets accomplished. And I know that's something that I'm learning a lot from you on. So thanks for the question. Over to you, Eric.
Well, maybe it's not directly answering the original question from Travis, but I'm going to go on the last thing that you said, David, which is what we're looking at is, I never look at digital currency, digital assets as a speculative market. Sadly, if you go and look at most of the industry, what's the trend in Bitcoin? What's the trend in ETH? Where's the value going to be? Should I buy Dogecoin? And trading in foreign exchange was something when I was much younger. People thought there was money in that, and we've kind of learned there isn't. It's really what you do with money that matters, and I think both of you said that quite eloquently today. What's happening with the digital platforms, it's not just the speed, and to your point, it's not just taking out the manual effort. It's taking out some of the innate human error, innate human laziness. Therefore, it's going to take out some human risk. We have to be careful with governance that we don't introduce artificial intelligence risk and other things. But that gets back to the smart contracts, that gets back to the known entities. And I think what's going to be transformative, and Travis and I have had a lot of good conversations about who the participants can be, because it's not only the onboarding of the entity as a person, it's onboarding the entity as a company, onboarding the associated rights of that person to represent an entity. It's the cross-validation that that person has the rights in the laws of the bylaws of the company and the regulations of the state it's registered in. With AI and setting up the smart contracts, that will be de-risked. So it gets, go ahead.
No. I just Baltimore just stuck in my head. It's the only county. There could be more now. This is old news, probably. They're all everything. They're trying to put all their recordization filings, court systems, everything at the county level on chain. Now, can you imagine when someone does a KYB and say, is there any liens, judgments, or anything? Immediately, it's like, boom. Oh, I got to do this. I mean, all the fraud that happens with someone claiming a title to something, all that nonsense, revenue recovery, all that stuff just opens up in the very
not just the county. If you look at the whole nation of Mexico, when somebody is born,
true.
They're given a digital token.
That's right.
They are put in the blockchain, so their birth record is consistent and it's immutable.
Yes.
And now when you go to things like voting registration, and you're getting to knowing somebody's health record and everything associated, you'll know that they have health benefits and so on and so forth. So it can be used, and I use the word can because we had very interesting conversations with Robert and others. You can't trust the system, but we now have the tools to set up very good systems.
That's true.
And it's like any tool. If you use the right way, you can do amazing things with it. If you're not careful, you can be used in horrible ways not anticipated. But it's not that I'm simply optimistic. I'm just saying that the tools exist, that we can create things that extend into new markets, create new markets, extend into new offerings for participants who couldn't participate before because they had to rely on traditional credit services and traditional banking services, which they couldn't control or afford. And we're now seeing that these technologies will definitely change all that. And as David said, create these marketplaces that we can't quite imagine yet, but we know are coming.
It's brilliant. Well, I'm going to keep to my word here. We've had our time here. So this is episode 3. Thank you very much, Eric, my co-host, and our guest here, David Petrie, for joining us today. Thank you so much.
Thanks, Travis.
Thank you, David.
Beautiful. All right. This is a wrap. Take care, everyone. We'll see you next time.